The 10 Rules for Successful Tax-Free Income Investing. Do you ever have doubts about your investing portfolio's performance? If you're like most investors, you've thrown your income-generating assets in with your equity portfolio. You're perplexed as to why your portfolio's complete mix of dividend-paying stocks, bonds, mutual funds, and equities isn't creating enough income or boosting your portfolio value. Part of the explanation I discovered is that investors almost universally neglect the long-term ramifications of their income investing selections in favor of short-term effects. I have seen many investors struggle with managing their investments. In most cases, it's not because they are unskilled or don't know how to invest. They just lack the time and knowledge to manage their investments properly. Because fixed income trading isn't as interesting as other sorts of stock market investing, it's been put to the ho-hum category by authors, and less ink has been given to its intricacies as compared to other types of investing. That, in my opinion, is a disservice to individuals considering this type of investment. Welcome to Stocks Galore, the place for those in passionate pursuit of financial freedom. Smash the like button now, subscribe to our channel, and click the notification bell to be notified when new videos are released. Investing for income, whether taxable or not, has a few common denominators, which have divided down into 10 rules. These will assist you in making smarter selections and viewing income-oriented investments with the proper mindset, so you don't have to continuously second-guess yourself. 1. It's critical to look at a portfolio's fixed income performance apart from its equity performance. Why? Because the goals are completely different. The primary purpose of owning fixed income securities is to generate a secure cash flow, either for spending or reinvesting until it is needed. Equity investments are for growth, whereas fixed income securities are for generating a secure cash flow, either for spending or reinvesting until it is needed. The long-term goal of most people's investment programs is to earn enough income to live on without having to touch the principal. Keep your equity account separate from your income-generating account to assess and manage your investments more effectively. 2. Interest rate sensitive refers to all fixed income securities. As a result, their market price will always vary inversely with the expected interest rate direction. With interest rates rising, prices will decline. Interest rates are expected to fall, causing investment prices to rise. All bond, preferred stock, and rate prices are affected. Accept it and make the best of it. The issuer's quality rating, the amount of time before maturity, or the call date are all factors that influence price movement. Remember that price variations in fixed income securities are not an indicative of the issuer's capacity to pay interest and have minimal impact on it. So, rather than beating yourself up when interest rates begin to rise, take advantage of the greater rewards. 3. Fixed income securities are typically held for a long time due to their nature. The amount of income received is a consideration to consider. Trying to predict the future direction of interest rates has no value, and I strongly advise you to avoid it, as well as continual monitoring of changes in portfolio value. Remember that fixed income investing operates in the same manner that your own finances do. Expenses are paid from your income, not your net worth. 4. Only invest in fixed income instruments where fees are clearly visible before making a purchase. To put it another way, a lot of new issues sold by brokers can have hidden charges. Markups are not required to be reported, although commissions are. On fresh issues, there are frequently exorbitant markups. 3% or more is not uncommon. Be careful what you buy. 5. Look for securities with the longest term possible, and only those that are rated as investment grade. If you're looking for a conservative option, there are a number of closed-end funds that are insured and don't use leverage. However, they have a little lower yield. 6. The same rules apply to all interest rate sensitive securities. This means that at any given time, the value of everyone's bonds will be moving in the same direction as yours. Don't give in to the temptation. Switching from one fixed income fund to another based on emotions, fear, or other non-objective considerations is not a good idea. Concentrate on diversity and stay away from assets that appear to be too wonderful to be true. Fixed income and equity investing both follow the same set of rules in this regard. 1. If it seems too good to be true, it probably is, and 2. You can't manufacture a silk purse out of a sow's ear, no matter how amazing the pitch. 7. The primary motive for purchasing fixed income securities is to generate income. When you genuinely understand this, The only number on your monthly statement that you should pay attention to is the income received figure. I recommend that you ignore the others. 8. To be a great income investor, you must also comprehend and agree with the following points. Fixed income investors benefit from higher interest rates because they put more money in their pockets. Lower interest rates help fixed income investors by allowing you to add capital gains to the total spending money generated by your investments. 95% of the time, changes in the market value of investment-grade fixed income securities should signify nothing to you. 9. Open-ended income mutual funds will not help you achieve your goals. It's no secret that fixed income investments practically never increase in value. Open-ended income mutual funds did not demonstrate the same level of gains as individual assets as interest rates fell over the last few years. However, closed-end funds did. 10. There are several reasons why using closed-end exchange-traded funds is beneficial to you. Low acquisition expenses, full liquidity, expert fund management, and monthly cash flow that is predictable. You're also given the option of buying more when prices drop and realizing capital gains when interest rates fall. Why haven't you been informed about these funds by your financial advisor? For the simple reason that the financial advisor suggesting them has nothing to gain. While these accounts may boost your monthly income, they won't help a commission-hungry salesperson. Why invest in tax-free assets? Tax-free assets are supposed to be an investment that can be utilized by investors who are looking for a safe haven to invest their capital. Investing in tax-free assets doesn't always mean investing in bonds or securities. There are many other types of tax-free investments like real estate, private equity, and commodities. Tax-free investments offer great opportunities for lower-risk capital gains. They also provide the potential of making higher returns with less risk than any other type of investment. Tax-free asset investments make good sense for high-net-worth individuals and corporations every time there is a major market correction because they can sell these investments during volatile periods without having to pay capital gains taxes on the profits made during those periods. Where to find tax-free investments? If you are looking for a long-term investment that will not affect your current cash flow, then you should consider investing in tax-free investments. These types of investments include municipal bonds, state and local government bonds, and Treasury inflation-protected securities, TIPS. The returns from these types of investments tend to be a little bit lower than other alternatives, but they can help you avoid paying taxes on the interest income. Tax-free investments typically have a guaranteed rate of return for a set period of time. This can be very appealing to investors who want certainty when it comes to their returns. If you're interested in investing in tax-free bonds, then one option is through mutual funds that invest in different types of tax-free bonds. There are many countries that offer tax-free options on investing in their countries. Many of these countries offer these investments to foreign investors, however, some of them also provide this option to domestic investors. How to choose a tax-free investment? First, you should find out if your state offers a state income tax deduction for investing in municipal bonds or Treasury inflation-protected securities. If so, you may want to invest in a particular type of municipal bond or inflation-protected security that would give you the most benefit with your state's tax break allowance. With the rising interest rates and the growing number of tax-free investments, it has become more crucial to know how to choose a tax-free investment. You should ask yourself, what kind of return do you want? Do you want cash? Do you want a high yield? These and other questions will help determine your investment strategy. The general rule for choosing an investment is long-term potential and not short-term gains. Taxes and the pros and cons of a tax-free investment strategy. Taxes and how they affect investors may be the most important factor in choosing a tax-free investment strategy. As we all know, taxes can be problematic. Tax rates for ordinary income, capital gains, and dividends are all too high at the same time that certain types of investments, like real estate and gold, are exempt from taxation. When it comes to investing, there is no such thing as a free lunch. The question is, do you want to pay taxes on your returns or not? And if you choose not to, what are some of the pros and cons of such a strategy? Some of the pros and cons of tax-free investments include: pros, because the investor doesn't have to pay taxes, they will not incur any capital gains, dividends, or interest taxes. The investor will also not have to pay any state or local taxes on their investment. There is also no risk of losing money from a taxable investment, because these types of investments are still considered safe. Cons: these investments would be subject to capital gains tax if they were sold before retirement age. However, most advisors recommend waiting until your 40s before selling them for a guaranteed minimum gain. Tax-free investment strategies, such as the Roth IRA and 401k plans, offer a number of benefits like tax-free withdrawals and tax-free growth. However, many investors don't account for the other negative consequences of these plans. The biggest drawback is that they don't offer any tax benefit when you retire. If you manage your portfolio, these 10 rules for successful tax-free income investing should help you make more lucrative investments. If you're unsure about putting together an income portfolio on your own, find a professional who deals with these types of funds and is familiar with the principles I've discussed, and allow him or her help you build the income you'll need to live comfortably in retirement. So there you have it. If you enjoyed this video, smash the like button now and subscribe to our channel to be notified when new videos are released.